Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and happy St. Patrick's Day to you. This is the St. Patrick's edition, and looks like the market's going to have a little bit of the luck of the Irish on its side today, as all eyes have been waiting on the Federal Reserve to come out with their comments after they spent the past 2 days in a summit. And so Jerome Powell speaking currently. I waited as long as I could to get today's video recorded. I really wanted to at least see if I could get an idea for the general theme of what he's going to say. And for now, it seems like it's been able to quell some of the uneasiness that's been happening within the markets, particularly concerning inflation and whether or not the Federal Reserve is going to allow inflation to run hot, as well as increasing the cost of borrowing money, interest rates, and will they continue to aggressively be buying bonds. And so markets have been kind of really nervously awaiting what was going to be presented by the Federal Reserve today, specifically Jerome. And so for now, it seems like the general consensus has been to keep rates bottom low, possibly begin raising them in the beginning of 2023. And that while economic indicators in some areas are beginning to have a little bit of a rosier outlook, that the Federal Reserve is going to remain pretty supportive in this recovery. And so it was funny, all across the three major indexes, literally, I knew that he must have been speaking because I could see the ticker out of the corner of my eye, and they all just kind of started ticking up. And so investors, it seemed that was kind of enough to be able to say, okay, things are okay, because you know growth stocks, can't speak today, in particular, have really been under pressure, and that's been a significant impact of the 10-year treasury continuing to rise. So today, 10-year treasury numbers rose again to a 12-month high of 1.676. And so markets, especially the S&P and the Nasdaq particularly, reacted negatively to that. And so to have Jerome come out and kind of reinforce the fact that they are going to kind of continue to be merciful with interest rates and with trying to keep the cost of borrowing money low as we continue to recover, that had a direct impact on stocks. And so want to talk to you right now with what we've been seeing within the Nasdaq and the S&P 500. So here's the Nasdaq first. So I mentioned the Nasdaq, which had been completely deviated from its long-term moving averages here, has been through this corrective process. We officially hit corrective territory last week. Corrective territory is as soon as we hit 10%. Now, shortly after that, within 3 trading days, it actually rallied back 6% over just a few sessions. And so last week when I was doing our video, remember I mentioned the fact that it was going to be really important that if we could get here and then hold the 50-day once we closed above that, which for now we've done. Now the Nasdaq, when I left to begin taping this, we know things change quickly, was going to likely be positive again. We'd been negative all day and it popped. It was about 0.6% when, again, as Federal Reserve was still speaking. So we'll likely hold that 50-day again today. That would be a good news for the index itself. And so you can see we hit right here, we hit RSI of over 70. Anytime we get to that point, that typically, not all the time, corresponds with us having a correction, which we have done. And so now RSI has stabilized. And typically looking back, when we see RSI kind of stabilize and then we begin to have a recovery, it's usually a good sign that we may be kind of coming to the end of that particular corrective process. So we'll have to see if that holds. So again, what we've been seeing within the Nasdaq has really not been anything completely unexpected. We absolutely expected to see some type of either a pullback or of us beginning to have sloppy trading sideways to burn off a lot of the excess, because anytime we get to this point, it's just kind of, that's what needs to happen. So true to form, we've been kind of going through that for the past couple of weeks. February and March are typically weaker months for the market to begin with, and so that's kind of played out as typical. So S&P 500, kind of more of the same. And so again, S&P 500 was absolutely here at the peak there, deviated beyond its means However, we went through our corrective process and then just yesterday actually hit a new high in the S&P 500. So again, doesn't really seem very much phased at all by these weaker periods of trading that we have been seeing. Again, S&P 500 was under pressure as well, particularly as looking at rising interest rates and how that would affect companies' ability to continue to grow. Just not quite to the point of the Nasdaq. Something else to consider. The Nasdaq was actually more, I would say, extended than the S&P 500 was, which is probably why the Nasdaq's correction felt a little more painful than the S&P's did, just because the Nasdaq was really egregiously overbought and kind of extended. So not completely surprising to see. The Dow has fared a little better in the midst of this, and so kind of expected that the companies in the Dow might be a little less affected by rising interest rates than the S&P and the Nasdaq. And so again, nothing out of the ordinary. We did cross back over the 50-day here, and we've held that very nicely and then had this kind of rally up. And so the question is really going to be for the Nasdaq. Now, can we hold? And if we go back, so can we kind of hold this here? Well, not that much. And go on then to make new highs. That's kind of the goal. Remember, last week we talked about the fact that a head and shoulder chart had very perfectly been plotted on the Nasdaq, and I showed you what we would need to do. So we did hold that second shoulder there where we needed it to be. So if we can kind of continue on this trend then and go ahead and make a new high, it'll kind of like erase that head and shoulders chart that we saw. And now my pen is activated. Technology is so great when it works. Okay, so I saw this chart and I thought, share with you the pain of the remembrance of where we were just a year ago yesterday. That was when the three major indexes all closed double-digit negative returns. Russell 2000 was down 14% for the day. The Nasdaq was down over 12. S&P was down over 11. Dow Jones was down over almost 13% for the day. And so sometimes as we go through these corrections or we have these negative days, it's kind of easy to be like, oh, that really hurt. But then you're like, you know what, maybe we're not so bad. Things aren't as bad as they kind of feel because that was a bad day. And so, I think we've been getting some different information regarding, where we are in the economy. And, some we were getting good news kind of mixed with bad news. Yesterday, we heard that for February, retail sales fell by 3%, which was very unexpected, especially because January we'd seen a really sharp rise in retail sales. So, different economists have different thoughts on this. A lot of that 3% fall coincided directly with some of the terrible weather that different parts of the country were experiencing during that cold snap. And so it's likely that that probably did impact retail sales just in terms of timing. Now we have stimulus that's hitting people's bank accounts even today, and so that will likely drive, I would expect, retail sales. We'll likely see a pop for March and then even maybe April. Unemployment claims do remain elevated. So it's estimated, it's likely that tomorrow we're going to see another 700,000 Americans filed for unemployment. While that is absolutely significantly down from where we were this time last year, where instead of how many hundreds of thousands, it was how many millions of employees are filing for unemployment. Back in 2019, pre-pandemic, 200,000 was the baseline. So we do still have a ways to go, although we are in a better situation now. We have Americans getting vaccinated. We're seeing most industries are open to at least some capacity, and many states are beginning to kind of open up those capacities even more. And so as we go into the summer, hopefully we can keep the virus counts kind of contained and down so that economies can begin to continue their expansion. So I think that even we're going to continue to get this mix of kind of good news and bad news, kind of like take 2 steps forward, 1 step back at times. And that's why it was really important for the Federal Reserve to be able to kind of reassure the market and investors that, hey, even though we're seeing some of these positive signs, it's kind of like not really ready to completely let the economy go out on its own, that they're going to continue to kind of baby it for a little while. And, people have all kinds of opinions about whether that is good or bad and whether or not that is going to wind up to kind of stifle us for the long run. But for now, what we are seeing is that we're going to kind of continue to get some support from the Federal Reserve, which is likely going to kind of continue to aid markets in their continued march onward, and we'll just have to see. But I do think that we are seeing positive signs within the economy itself of a recovery that's continuing, but it is just going to take time to kind of get back to where we were after we had so many of those areas shut down. So good to see that we were not reliving this again, and we'll just and so just to close, just wanted to just send a reminder that this is my contact information. So if you have questions, ideas for what you'd like to see me bring for the next few weeks, I'm working right now on a series of kind of like an adult education course talking about how you can get your financial house in order, looking at things like regaining your control of your credit, paying off debt, how to start beginning to save for retirement, being responsible, those things. So we're going to kind of bring you like that as a series. And then as well as we're going to begin hopefully bringing some other professionals in to talk about their areas of expertise, so we can hopefully bring value to you as you continue to listen and follow us. So really looking forward to that. But if you have questions, we're always here to help. We're happy to help you review what you're currently doing within your financial plan, and if there's anything that we can do to help you with that, we would love to. So thank you so much for joining us. I hope you have a great week, and we'll see you next week. Take care.